Welcome back. Today's explainer is a deep dive into something you've probably wrestled with if you follow the markets. We're starting with the basics of retail gold investing and following that thread all the way down into the hidden, legalistic mechanics of institutional gold vaults. Whether you're looking for a store of wealth or just trying to figure out how giant funds actually handle thousands of pounds of precious metal, you are exactly in the right place. Let's get into it.
Okay, let's dive into this. Here's the roadmap for today. We'll hit the golden dilemma, paper gold and fees, the physical redemption option, meeting those massive minimums, and finally, who is actually guarding the vault.
Starting off with Section 1, the golden dilemma and the real friction of physical bullion. So you want to diversify with what's often called the barbarous metal. It brings up a surprisingly tricky question. How do you actually own gold? I mean, it's been currency for millennia, right? And we still love it as a store of wealth today, especially when the broader banking system gets jittery. But physically getting your hands on it right now, well, it's kind of complicated.
If you just stroll into a coin shop to buy bullion, bam! Immediate friction. You're never, ever paying just the pure spot price. The dealer's got to make a living, so there's a markup. Even buying straight from the U.S. Mint means covering their production and sales costs. And then, what do you actually do with the stuff? You can't exactly bury it in the backyard. You're shelling out for a heavy-duty home safe or renting a safety deposit box. Plus, you have this constant, looming risk of physical theft to worry about.
That brings us to Section 2, paper gold and fees, the digital alternative and its hidden costs.
All that physical hassle naturally pushes us toward the digital alternatives, ETFs. Two absolute giants in this space are SPDR Gold Shares, ticker GLD, and the iShares Gold Trust, ticker IAU. Now, these funds literally own millions of ounces of physical gold, and their share prices track the metal perfectly. But here's the catch. You don't actually own the gold. You just own shares in the ETF. If the world goes sideways, you can't exactly demand your bars from them. And on top of that, you're paying them a management fee. GLD takes a 0.40% expense ratio, while IAU is a bit cheaper at 0.25%.
Now, what's really interesting here is the dramatic long-term impact of those tiny little fees. Both of these funds launched way back in late 2004, early 2005. They do the exact same thing, hold gold. But because of that slight fee difference, 0.40% versus 0.25%, the long-term returns drift apart significantly. Over time, GLD grew by just under 880%, but the lower-cost IAU jumped almost 904%. That tiny 15 basis point difference, it compounds massively over the years. It's wild.
Moving on to Section 3, the physical redemption option, bridging the gap between paper and metal.
So what if you want the digital convenience, but you still want the option to hold the actual metal in your hands? Enter the Sprott Physical Bullion Trusts. These are closed-end funds set up in Ontario, Canada, and they explicitly give you, the unit holder, the right to redeem your units for physical metal every single month. It's kind of the perfect bridge. You can trade the fund digitally on the New York Stock Exchange, but legally, you can still yank your actual bullion right out of their vault.
But wait, how does that actually work in practice? You can't just tap a button on your brokerage app. Imagine this. First, you have to formally request a physical trust unit certificate through the direct registration system. Then, you've got to secure a signature guarantee on a valid redemption notice. And timing is everything here. That notice has to be received by exactly 4 p.m. Toronto time on the 15th of the month. Finally, you physically mailed the completed paperwork to the TSX Trust Company in Toronto. It is an intensely analog, highly specific process for a digital asset.
Which leads us to Section 4, meeting the minimums, the heavy reality of institutional gold.
And here is the catch. You can't just ask them to mail you a cute little 1-ounce coin. We're talking institutional vaults here holding massive commercial-grade bars. For the PHYS Gold Trust, you need enough shares to claim one full-sized London Good Delivery bar. That is roughly 400 ounces of gold. Want silver from the PSLV Trust? You need enough for 10 1,000-ounce bars. For the mixed CEF Trust, you need a minimum of 100,000 units, and for platinum and palladium, a minimum of 25,000 units.
And this brilliantly illustrates the vast gap between retail expectations and institutional reality. Look, a single 400-ounce gold bar weighs about 27 pounds. 10 1,000-ounce silver bars? That's over 680 pounds of metal. Taking delivery of this kind of weight requires armored trucks, armed guards, and some serious capital. It's a wildly intense undertaking that, frankly, is completely out of reach for your average regular investor, even though the option technically exists. All right, final stop, Section 5, guarding the vault. The oversight keeping the system fair.
So, if you're parking your wealth in these massive institutional vaults, who is actually keeping an eye on things? Well, behind every trust is a legal framework acting as your shield. For the Sprott funds, it's the Independent Review Committee, or IRC. Operating under a Canadian securities law known as National Instrument 81107, this committee's main job is reviewing the manager's actions to resolve any potential conflicts of interest. They are there to protect you, the investor.
It's so easy to think of these financial structures as giant, faceless machines, but there are real humans looking out for your interests. For instance, the chair of this independent committee is a man named Kevin Drynan, based up in Clarksburg, Ontario. So, the crucial point is that Kevin, a retired financial services executive, along with other committee members like Fraser Howell and Jeff Salmon, are entirely independent from the fund managers. Think of them as the referees of the fund. They don't own stakes in the funds, the manager, or the service providers. Their whole mandate is just making absolutely sure that if a conflict of interest pops up, the outcome is totally fair and reasonable for the security holders.
Now, to keep a multi-billion-dollar operation moving without drowning in red tape, they use something called Standing Instruction Number 1, Omnibus. It's basically the grease in the gears. It lets fund managers automatically handle standard operations, like expense allocations, valuing the portfolio, fixing tiny trading errors, and managing third-party providers, without calling a formal committee meeting every single day. As long as the manager sticks to the strict policies laid out in the Omnibus instruction, the operations proceed incredibly efficiently while still being completely governed.
We've covered a ton of ground in this explainer, from those annoying markup fees at your local coin shop to the stealthy long-term impact of ETF expense ratios, all the way to the armored truck reality of pulling 400-ounce bars out of an Ontario trust. It really all boils down to a fundamental trade-off between friction, fees, and safety, which leaves us with one final essential question for your portfolio. Ultimately, do you prefer your gold locked in a heavily regulated, managed vault, tracked efficiently on a digital spreadsheet, or sitting right there in your living room safe? Think about your strategy, keep learning, and I'll catch you in the next explainer.